Welcome, it's Drew Blazik. We're going to do the level 1 3 statement model in this example. Level 2, it doesn't mean it's necessarily harder. It's just that it's different of how we're going to calculate when we come to the income statement and I'm sorry, the balance sheet and the cash flow statement, and also with deferred taxes. So it's actually looking at it another way, not necessarily a more difficult way of doing it. So this is going to be the model 1 here. So first thing you want to do is make sure you type your name up in the corner, and it's going to timestamp it. Macros ran, and we'll go straight to the model. Okay, so when we do this model, I want to thoroughly explain the income statement, cash flow statement, balance sheet as we're going through it. I will not solve these ratios. You can look it up in the PowerPoint, and you can see how to solve the ratios. You can plug the numbers in. So what we're going to do first, let's go straight to the income statement. And now typically when you're doing these, the first part is gross profit. Well, what is gross profit? It's the revenue. It's the sales of the units minus cost of goods sold. Number one you want to look at is how does the cost, how is it represented? This is as a negative, right? You're always going to take the revenue minus cost of goods sold. Since it's already a negative, all you're going to do is hit Alt equals. That's important because if cost was represented as a positive, you have to subtract out cost. Since it's a negative, I'm just going to add those two up. So I'm going to hit Alt equals, and then I'm going to hold down Shift and hit Control R. Next, what we want to do, I want to take the gross profit and I'm going to subtract out these two costs, which is sales, general and administrative, and then also other costs that we have. Now with this, we don't have, I'm not going to do the all equals because if I did all equals, it's just going to sum up those two. So what I'm going to do is I'm going to hit equals and I'm going to hit the sum function. And I'm going to hit the arrow up, and what I want to do is hold down Shift, and I'm going to add our gross profit, and I want to subtract out those two costs, which are already as a negative. So I'm just going to sum all those values up, hit Control R, and that would fill to the right. Next, what we want to find is operational income, which is EBIT. So I'm going to hit equals, and I'm going to hit sum. Hit tab, go into the function, hit the arrow up, hold down Shift. I want to highlight the EBITDA minus this. Hit enter, Control R, drag it over. And then we'll do the same thing with interest before taxes. I'm going to hit sum. So the income statement in the level 1 or the model 1 is fairly simple here. We're just really taking the last previous calculated field and we're going to subtract out the next cost. Down here we got current taxes, deferred taxes. Now just so you know, on the income statement, current taxes is what you actually pay. Deferred taxes you're deferring at a later period. But on the income statement, we're subtracting out both of those, even though deferred taxes is deferred at a later period. So in this example, all we're going to do is I'm going to sum up the taxes. I'm going to hit all equals. I want to get that value. I'm going to have it tab over. And then for the net income, I'm going to go equals. And then I'm going to take the EBT. And I want to subtract out the taxes. Since taxes is already as a negative, I'm going to add in the taxes, which is the same as subtracting it. And then we have, let's go to our grade, 100% completed of the income statement. All right, let's go to the cash flow statement. Before we go forward with the cash flow statement, I just want to explain the difference between the cash flow statement and the balance sheet. When you see the cash flow statement, you want to think about the cash flow statement is a change in cash. It's how does certain items in the balance sheet, are we increasing, decreasing certain items? How does it change our cash? So it's very important. If it's the outflow, if it's cash outflow, we want to represent that on the cash flow as a negative. And if it's a cash inflow, we want to represent it as a positive. On the income statement, it depends how people put it. Sometimes they put it as a negative, sometimes a positive, and you just have to look at that and say, okay, am I subtracting or adding? So as we go forward and talk about these, especially for the level two, this one's not as hard for the cash flow statement. For the level two, we will talk about it more in depth about the cash flow statement. So first thing, so you got three parts of activities on the cash flow statement. We have operations. That's through the company's operations. You got investing. That's when companies want to buy typically more CapEx, which is connected to property, plant, and equipment, long-term assets in that regard. And then we got financing. Well, how are we financing these activities? Do we have a shortfall for the year? Do we have to have a line of credit? Are we issuing new term debt? How we finance? Are we issuing equity in order to purchase the investing opportunities? So when we look at operations, it's important to see when we did the income statement was not a correct, I would say, method to find out how much cash we have. The income statement isn't showing our change in cash. So, for example, if someone comes into your store and they purchase $100,000 on credit, according to the income statement, you have a sale of $100,000. According to the cash flow statement, you haven't received that cash yet. So we have to adjust the cash flow statement to represent what happened at the income statement. Another couple items. Depreciation. We subtract out depreciation for tax purposes on the income statement. However, that was never a direct outlay of cash. It wasn't a direct payment of cash because depreciation was the depreciation of long-term assets that we get to subtract out so we don't pay as much taxes. So it's important to see those things. And then the third one is deferred taxes. I subtracted it from the income statement, but I deferred it for a later period. Therefore, we have that money on the cash flow statement. So when we're solving the cash flow statement, you want to think about why are we adding it? Why are we subtracting it? So the first thing we want to know is, well, how much money are we bringing in? So that's going to be tied to the income statement. We just solved net income at the bottom. So we want to find out the forecasted 2023. So I'm going to go all the way to the income statement, and I'm going to link that up. Next is depreciation. Since depreciation, so I'm bringing in net income from the income statement. However, I subtracted out depreciation, but that was never a direct outlay of money. Therefore, I have to add back in depreciation. Depreciation is negative on the income statement, so I have to make that a positive value on the cash flow statement to add it back in. So you could do two ways. I could put a negative and then select depreciation. Another method is to do the absolute value to make sure I get a positive value. What's nice about absolute value is that just in case if depreciation was added as a negative, I'm sorry, as a positive, and we subtracted it, then that negative wouldn't flip the sign. We always want it as a positive. Absolute value would do that. Next, deferred taxes. I'm going to do absolute value as well. It is shown as a negative, but I want to make that a positive. And then all we do with the subtotal is we're adding up, and just kind of show how it works here. We're adding up net income. Well, I'm going to add back in depreciation. I'm going to add back in deferred taxes. And then, and we'll see this in the level two or the model two three statement model, is we are looking at the change in accounts receivable, the change in inventory, and the change of accounts payable. And just kind of get a good idea how that works is imagine someone comes to the store and they're always buying $100,000 on credit. Well, the income statement shows I got a sale, but I didn't receive that money. Well, if it's $100,000 every single period, there's no change in accounts receivable. But what happens if $100,000 happened this month and then next month or next year, it jacked up to $1 million? So if I have a lot more people come in purchasing on credit, I don't have that cash. So we have to represent that in the cash flow statement. All right, so what I'm gonna do is hit all equals. I'm gonna sum up everything above. I'm gonna hit equals, and now we can just drag it across. So all I have to do is highlight those. I'm gonna hit Control R, and then highlight the sum value, hit Control R. Next is cash from investing. Well, we only invested in cap X. Typically, it's pretty simple on these models. And I'm just going to sum it up. And you want to hit highlight it over and hit Control R. Next is from financing. We have line of credit. Typically, that could be a revolver, term loan issue. Do we buy back or do we issue new equity? Are we buying back the stock that we had before? So I have more control over the company, or are we selling more of the company to raise money? That's already all solved for us. So all we have to do is add up the total. And then what we want to know is, what is the cash balance? This is called a corkscrew technique, is where we want to know the beginning balance, the change in balance, and then the end balance. So this is what I'm going to do. To find out how much cash we brought in this year, the beginning balance, not the ending. So we have to find out the beginning, we'll put that in, and then we'll find the change. So to find that out, you always want to think about, well, where is a balance of cash? Where is that found? Cash flow statement is the change of cash. However, the balances is found in the balance sheet. And as you can see in the balance sheet, we have our forecasted years, and then we have the last actual years. This is the last recorded years on the balance sheet. And we have a ending balance of the previous year of 2022 of $4,000. So that's going to be our beginning balance, what we're bringing in. So I'm going to corkscrew that in, and really the ending balance of cash for every single year will be the beginning balance of the next year. Okay, so 4,000 is for 23, and then this number would be for 24 down here. All right, next we want to find out, what is the change in cash? Well, that change in cash is found in the cash flow statement. So what I'm going to do is I'm going to add up what's the cash flow from financing. I'm going to hit plus. What is the cash flow from investing? I'm going to hit plus. And then what is it from operations? That's how much cash we made for that year. So we have the beginning balance, then we got the the change in balance, and then all I have to do is hit all equals to find the ending balance. So I'm going to highlight those over. And you can see it's not correct yet, because I'm going to go up to the balance sheet. And the balance sheet, I have to find out the cash totals, because it's corkscrewed in, as in the beginning balance is always the previous year of the balance sheet. So what I have to do is, well, what is the ending balance of the balance sheet? Well, that is found, what we just solved. So I want to find out the ending balance of 2023 is the ending balance of 2023. It's right here. So the cash balances is where we find out the ending balance on the balance sheet. So I'm going to select this cell, and we'll see it all of a sudden start lighting up green. See how that lit up green? That's correct. I'm going to scroll out a little bit so you can see this work. So as I shift this over, you're going to see the cash flow statement all of a sudden now it's filled. So again, I'm going to pick 2024, and you can see the beginning balance is the ending balance of the previous year. And then what I did was I wanted to find out, well, what happened with our cash flow through operations, investing, and financing. I'm going to add that in, and then I total it up. And then after I total it up, the ending balance becomes the end balance of the balance sheet. So then it just corkscrews back in. All right, so let's make sure our grade looks good. Our cash flow statement and our income statement is 100% complete. So next what we want to do is finish the balance sheet. Okay, so I'm just going to total this up. so we know what we're doing correct. I'm gonna go over. So what I'm gonna do here is I have to find out. So if I go back to the cash flow statement, I have the change of cash of the accounts receivable. And this is what I really have to explain to make sure we understand this. The change of cash of accounts receivable. I have the balance of accounts receivable, the total balance. Like how much, now what is accounts receivable? That's an asset on the balance sheet. That's what people owe me. That's people coming to my store and buying my goods and services on credit. So what I want to know, what is my total balance? Now, before we do that, as we can see, this this is a positive value. I want you to think what that means, and I'm going to thoroughly explain it, and then I'll give you a rule of thumb of how assets work. We have a positive value increasing in cash each year on accounts receivable. So what does that mean? If I have what is accounts receivable? People owe me money. Well, if I have someone coming in every single, oh, let's do it percentage wise. Let's say 20% of your customers buy it on credit. That means I have 80% of the money today. They all bought in cash, 20% bought on credit. However, what happens to my money if 50% buy on credit? Well, my cash flow would go down, right? If 100% of people came in this year and bought everything on credit, I don't have any cash. That means my cash flow went down. However, if I have the same amount each year, that means my cash flow remains the same. So if I had 100,000 this period, that means the next year, if I have 100,000, that means the previous 100,000 just paid me cash that period, and then I'm owed again. And then the next period, I receive the cash, but I'm owed it again. So there's no change. That's important to see. So this is an increase in cash. So if accounts receivable is adding cash to uh, um, my how am I saying this? If accounts receivable is adding cash to my company, that means I'm having less people purchase on accounts receivable. They're paying me cash, right? The cash flow is going up from accounts receivable. So that just means instead of 50% of people paying a credit, now only 10%. I'm getting more cash coming in. So we want to know is what is the impact on accounts receivable, the total balance? Well, I just said it's going down, therefore the balance should be going down. So this is how we're going to calculate it. The balance of accounts receivable is going to be the previous period. And this is the balance sheet, the total balance. And what I want to do is uh, all assets have a negative relationship with cash, okay? Which means if my current assets are going up, like inventory, accounts receivable, if they're going up, that means my cash is going down. If my accounts receivable and inventories is going down, my cash is going up. So what I'm going to do is I'm going to hit a negative. It's a negative relationship. And then I'm going to go to that cash right here. And then that's, see what happened? I had a 6,000 balance. Now I have a 4,000 balance. Why do I have a 4,000 balance? Is because 2,000 less people purchase an accounts receivable. Less and less people are doing that, which means I have more cash, right? I have to add cash back in because that change happens, a change of accounts receivable. And again, I want to emphasize, if it's the same number coming in each year or each month, that would be zero, the change or the cash flow. Because if $100 was owed to me last month and then $100 is owed to me this month, that means the previous month would pay me this month, and now I'm owed another $100, nothing changes. So there'll be nothing change. However, we're declining it. Oh, now, if you're confused, hopefully inventory will clear it up. As you can see, inventory has a negative cash flow. So what does that mean? If you want to increase your inventory, so let's say you have $100,000 worth of inventory, you want to have 200,000, well, I have to pay it out of cash. So if I want to increase inventory, I have to use cash. So if inventory goes up, my cash goes down. However, if you have $100,000 worth of inventory and you sell it all, right? And it goes down to zero, that means my inventory went down, but my cash went up because I sold it through. So again, that's an asset and it's a negative relationship with cash. So I'm going to go equals, and I'm going to go to the previous year, and then I'm going to subtract out my change in cash. All right, what's going on is that we paid, now this is in thousands. So we paid 1.5 million of inventory. So our cash went down by 1.5 million, but that's minus a minus. That means our inventory increase from 2 million, or we'll just say thousands, 2,000 to 3,500, right? So hopefully that makes sense, that assets are a negative relationship. And then we'll talk about liabilities in a second. So next is property, plant, and equipment. This is a long-term asset. This model doesn't break that down. So it just has assets all wrapped up in one. All right, so we really have to think about this one. This one's a little bit different. Now, it's an asset. It's a negative relationship, correct. Now, what do we want to look for long-term assets? Property, plant, equipment, that's capital X. Look what we're doing here is we spent $4,000 on purchasing more property, plant, and equipment. That makes sense. If this is negative, I spent that money to increase this. If this was positive, if I had money coming in from capital capex, that means I sold buildings, I sold plants, I sold property, machinery, I sold things, I made money. So again, if that's a negative, that means this is going up, right? If this is a positive, this is going down. So it's a negative relationship. So I'm going to go equals. So I want to find out what is my property, plant, and equipment? What's my total balance? Well, it's a little more in depth than the previous current assets. So I'm going to do the previous balance, and then I'm going to subtract, because negative relationship, this value. Again, why am I subtracting it? It becomes a positive. So it's technically adding it back to the 63. Now, if I hit enter, it's going to be incorrect. Okay. Now, we did this correct, right? We have $63,000. I added in 4,000. Again, this is in thousands, but I'm just going to say it for make it easier. I added it. So now we should have 67. But however, property, plant, and equipment has a deduction of depreciation. Depreciation. So that land, all that stuff that we had is going down in value. So what I'm going to do is you could subtract out depreciation, or you can add in the income statement because it's already a negative depreciation. And as you can see, there's no change in property, plant, and equipment. But you had to do it to make that correct. Why is there no change? Because I added 4,000 in capex, but it depreciated by 4,000. So that's why we have those balances. So what I'm going to do is I'm going to highlight these, hit Control R, and we just filled the asset part. So right now we're 40% complete of our balance sheet. All right, let's do liabilities. Yeah, I'm going to just do that bottom real quick. All equals. Shift, Control R. Now I want to find out, well, what is my balance accounts payable? What's accounts payable? It's a liability. Accounts receivable is what people owe me. That's an asset. Accounts payable, as a company, what do I owe others? I always do retail as an example. So it's like Whirlpool sends Lowe's Home Improvement a washer, right? And let's say Lowe's is going to pay Whirlpool back at the end of the month. They're not going to do it as the items come in, it's accounts payable, but it could be many different kind of things. Anything that I owe a vendor next month, next period, or whatever. So I want to know, do I owe anything? Now this is debt. You could think about accounts payable. No, accounts payable is not debt, but you could think of it as perspective as like a credit card. Here's a good way, easy way to think about it. If I go to the bank today and I say, hey, I want $1 million loan, and they give me $1 million loan, well, my liabilities, my credit, my debt goes up by $1 million, right? Makes sense. But what happens to cash? They just deposited $1 million into my account. Therefore, if my liability goes up, my cash goes up. On the same thing, let's say you owe 10,000 credit card debt. Well, if you want to get that down to zero, right? If you want that liability to go down, what do you use in order to pay it off? Well, it's cash. So if liability goes down, your cash goes down. Liability goes up, your cash goes up. So it's a positive relationship. So that's the important thing. I want to make sure you understand that. So let's go to accounts payable. So I'm going to go equals, of course, a balance. I want to know the previous amount. And then I'm going to look at, let's go find accounts payable. It's right here. Well, we are adding accounts payable. Each period, each year, I'm adding another $1,200 or 1.2 million onto what I owe, right? This is the change of cash. That means next period I owe it, but I'm owing even more. It's increasing at 1.2 million per year. So I'm going to add, I'm going to do the previous balance plus this. So if you want to look at it this way, it's increasing each period by that amount, right? It's a positive amount. So it's increasing by that amount. All right, line of credit. Again, I'm going to do the previous amount. I got to find line of credit. That's through financing. You either going to issue new debt, right? I want more. I'm going to repay off my debt. Am I going to get a new credit card? Or I'm going to pay off my existing credit card? Or am I going to have no change, right? If it's no change, it's the same amount, and I'm not paying it off anything extra. So I'm paying it off and I'm increasing it. So I'm paying off 1,000 this month, but I'm putting another 1,000 on it. That would be zero on the cash flow statement. You see the line of credit is changing $800, then 2.2, and then 1.45. Each period, it's a negative, which means you want to think about it, if it's a negative, that means cash is leaving. That means I'm paying off my line of credit. So what I want to do is I'm going to take that $5,000, I'm going to hit minus, and I'm sorry, I said minus. I'm going to do plus. Remember, it's a positive relationship. All liabilities are positive, so you always want to add it back in. So I'm going to do the previous amount. This one, 5,000, and then I'm saying plus, but really it's subtracting because it's already a negative, right? It's already a negative. So I paid off 800 off my line of credit, $800 left, and I owed 5,000, and now I owe 4,200, right? Term loan, same thing. Well, I want to know the previous amount, and then I'm going to add the change of cash. I'm paid each year. I'm paying off $4,000. So 4,000 is leaving my account. I'm not issuing new debt. I'm paying off my term loan by 4,000. So I'm going to do a plus sign because it's already a negative, but technically I'm subtracting. And it's going to decline by 4,000 each period, and that'll be my balance. Deferred taxes. So we have to kind of think about deferred taxes, how this is going to work. Well, I have a total amount of deferred taxes of 1,000. So I'm going to go equals. And then you want to look at where is deferred taxes. That's through operations. We are adding. So if you go to here to the income statement, so each year I'm adding 2,000. That wasn't a direct outlay. In the income statement, I include it. On the cash flow statement, I'm adding it. So I'm going to do a plus, right? Each year we are adding $2,000 in deferred taxes. That's how that works. All right, so I'm going to highlight all those, hold down shift, highlight over, hit Control R, fill to the right, make it quick and simple. Next, what I'm going to do is I'm just going to add this up. This is our equity. And then I'm going to find out what is my total liability and equity. And hopefully this is going to be zero, the check, because the balance sheet must balance. And I'm going to go to the equity. And then I'm going to hit plus. And then I'm going to go to the total liabilities. And that is correct. Okay, so now we got to fill up equity. Where's all this going to be found? First off, we have equity capital. You want to think about equity capital as issuing new stock. Are we buying back stock? Are we issuing new stock? That'd be equity capital. We want to find out how much of a balance we have. Well, to find out, are we adding to it or taking away? You want to go to the cash flow statement. And then we have right here from financing, we have equity, issue, and buyback. And you kind of want to think about, well, what is equity? If this is a positive amount, that means I'm receiving cash. That means I'm issuing new stock. I'm issuing new stock and I'm receiving money through my investors. If this was a negative, that means I'm buying back equity. I'm using $1,000 to buy back my stock. So since that's a positive, our equity capital is going to be the previous balance. And I'm going to hit, oh, let me scroll over so you see it. So I did the previous balance and I'm going to hit plus, and then I'm going to go to our equity, and I'm going to add in that cash. So the balance, we're adding in more common stock, we're issuing more common stock, investors are purchasing it, and it's increasing our balance. Hey, retained earnings. This is a little, especially for the part two, I believe, is the more difficult part. What is retained earnings? Actually, I'm going to open this up real quick. And what I'm going to show here is when you have an income, or I'm sorry, let's say net income. That's on the income statement. Well, there are two things you could do with that money. You could pay dividends. That's number one. Or you could do retained earnings. So you could pay the shareholders, or think about if you own a business, you could take a profit. I'm sorry, you could take a paycheck, you could take a salary, or you take all that money, you could put it back into the company and you want to grow fast. So established companies may pay their owners at a higher rate. New companies want to grow fast. So what I want to do is think about, how do we know if this amount is going up or down? Well, we got a bunch of ways of looking. Is number one, I want to look at our net income. Our net income is positive. So through that, there's two things you can do with it. Number one, I could pay dividends and look at the cash flow from financing. There are payment of dividends, and that's a cash outflow. So I'm paying 1.2, 1.3, and 1.1. I'm paying the shareholders that amount. Then the remaining balance must go on to my retained earnings. So let's go. Let's do this. I'm going to go retained earnings is equal to the previous amount, right? And then what I'm going to do is I'm going to add in our net income. That's how much money we made for that year. Two things you can do with it. And then through that, I'm going to subtract, but since it's already a negative, I'm going to add that paid in dividends, right? So again, your net income, there's two things you could do. You're either going to pay the you're going to retain earnings or dividends. And through that, you can see how much is going to be added back in. I'm going to hit all equals. I'm going to go up here. I'm going to hold down shift, highlight those, hit control R. That looks good to go. Now my liabilities and equity, I already solved it. Hit control R. The balance sheet balances. Let's go to the grade. Make sure it looks good. 100% net income statement, cash flow, balance sheet. And then, like I said at the beginning, I'm not going to take up your time, but you want to look up those equations, and I want you to solve those. And I'll just do it real quick, like profit margin, right? Profit margin. You want to think about that's going to be our net income divided by our revenue. So you kind of want to see where all this stuff is located. Once you solve one of those, you can hit control or shift over control R and fill over. And then profitability ratios. And then once you complete that, the whole thing, your final grade should show 100%. And I'm going to delete that. There you go. And I'll just suggest to do this. I'm going to have an exam on this model. So I just recommend people to practice it. And a great way to practice it is just hit that sim reset. And it's going to delete everything I did. And just do it until you feel comfortable. And you can say, I know this inside and out. Once you understand this, everything else, the financial statements just make sense. So there you go. God bless. That's all I have for today. And then the next video is going to be on the part two, the level two, or the model two, which is going to look a little different.